Have you ever looked at your investment portfolio and thought dividends were just free money? Well, you're not alone. If you have any money in the stock market, you've probably been told that dividends are the ultimate secret to passive income. But here's what most people don't know. Almost everything we're taught about this topic as beginners is completely backwards. Let's dive right into this explainer and uncover the actual shocking reality of how dividends work.
You might think a dividend is just a nice little cash bonus from a profitable company, right? Like extra money magically appearing in your account. We're going to bust that myth right now. Did you know that when a company pays out a dividend, its share price almost always drops by the exact amount of that dividend? Seriously. Let me explain why that happens. People love the old saying, money makes money. Financial bloggers and advisors are constantly comparing dividend stocks to buying a cow. The idea is the stock is the cow and the dividend is the milk it produces for you. It sounds great, but as the financial blog Boomer and Echo points out, dividends aren't milk. A dividend is literally just a company moving cash from its own balance sheet straight into your pocket. So the cow isn't producing milk out of thin air. It's actually transferring its own body weight into the bucket, lowering its overall value in the process. To put it in super simple terms, just imagine you own a lemonade stand. At the end of the month, you've got $100 in profit sitting in the cash register. Now you have a choice. You can either use that $100 to buy a new blender to grow your business, or you can take it out and put it in your wallet. If you take the cash, the business is now literally worth $100 less. That's exactly what a dividend is. It's just a business deciding to share its spare cash with you instead of reinvesting it into itself.
Section 1. The step-by-step dividend timeline.
So how exactly does this cash end up in your hands? It follows a pretty straightforward timeline. First up is the declaration date, which is just when the board of directors officially announces, hey, we're paying a dividend. Fast forward a bit to the ex-dividend date. This one is absolutely crucial. If you buy the stock on or after this specific day, you do not get the dividend. Because of that, this is the exact day the stock price drops to reflect the cash leaving the company. Right after that is the record date, where the company just checks its books to see who exactly owns the shares. And finally, the payment date arrives, and that cash actually hits your brokerage account.
Section 2. Real U.S. examples. The dividend aristocrats. Now, what's really fascinating is seeing which massive American companies can actually pull this off consistently. Enter the dividend aristocrats. These companies are the ultimate royalty of the S&P 500. To make this list, you can't just pay a dividend. You have to actually increase your payout for 25 consecutive years. Think about that for a second. Through major recessions, market crashes, global pandemics, companies like Abbott Laboratories and S&P Global have steadily increased their cash payouts to shareholders. They are mostly stable old economy blue chips, the big manufacturers and consumer product giants that just constantly churn out massive cash flows. But it's not just the old industrial giants doing this. The history of American dividends is super interesting. It really kicked off way back in 1882 with Standard Oil, which we now know as Exxon. But here's the thing. Even the giant modern tech companies eventually mature. They get to a point where they generate so much cash, they literally run out of ways to reinvest it, so they have to start paying dividends. We saw this exact shift happen with Microsoft in 2003, and then again with Apple in 2011.
Section 3. Mistakes, myths, and dividend traps. But here's what most people don't realize. Blindly chasing these payouts can lead to some devastating beginner mistakes. You have to watch out for the dividend trap. This happens when a company's stock price crashes, which mathematically pushes its dividend yield sky high. A beginner might see a massive 10 or 12% yield and think, wow, I hit the jackpot. But in reality, the market is pricing in the fact that the business is probably dying. They're in financial distress, and usually right after you buy the stock, they slash the dividend to zero, the stock crashes even more, and you lose both your income and your initial investment. It is brutal. You also have to be incredibly careful about taxes. The IRS does not treat all dividends equally. If you buy a stock right before the dividend pays out and then sell it immediately after, that's classified as an ordinary dividend. It gets taxed at your regular income bracket, which can be as high as 37%. But if you hold that stock for at least 61 days around the dividend date, it magically unlocks qualified status. This slashes your tax bill drastically, bumping you down to the much lower capital gains rate. In fact, if you manage your overall income brackets correctly, your tax rate on those qualified dividends can literally be 0%. Zero. That is a massive difference in your actual take-home wealth, just for understanding a simple 61-day holding rule. And that brings us to another huge misconception. A lot of investors use dividend reinvestment plans, or DRIPs, to automatically use their dividends to buy more shares. It's an awesome tool for compounding your wealth. But the myth is that because the cash never actually hit your checking account, it's somehow hidden from the IRS. That is completely false. You absolutely still owe taxes on that money in the year it's paid, even if it was automatically reinvested into fractional shares behind the scenes.
Section 4. Valuing the payout. So how do Wall Street experts actually value these dividend-paying stocks without falling into those traps? Well, analysts use sophisticated math, like the dividend discount model, to calculate the present value of all future dividends. But as the data from NYU Stern clearly shows, the math can get incredibly messy. If you guess wrong on a company's payout ratio or their growth rate suddenly changes, you can end up with wildly inaccurate valuations. It's a powerful tool for sure, but it is definitely not foolproof.
Section 5. The key insight: total return.
Okay, let's cut through all the complex math and get to the single most powerful takeaway you need to remember from this explainer. It all comes down to total return. Total return is just your price appreciation plus your dividend income. That's it. $1 of dividends and $1 of capital gains are the exact same dollar. A stock growing 8% with zero dividend gives you the exact same pre-tax outcome as a stock growing 5% with a 3% dividend. Plus, if you own a non-dividend stock that's growing, you can just sell a few shares whenever you need cash. Economists call this a homemade dividend, and it puts you in total control of your own taxes and timing. At the end of the day, whether you're spending cash dividends sent to you by a company or you're selling off your own shares to create your own income, the golden rule is simply this: you shouldn't erode your capital base faster than your portfolio is growing. It really is that simple. We need to stop looking at dividends as magical free milk from a cow and start looking at our entire portfolio as one unified engine for wealth. So ask yourself, are you building a portfolio designed to actually grow your wealth over time, or are you just buying a really expensive cow? If this changed how you look at your investments, remember to subscribe so you don't miss out on our future deep dives. And definitely check out our next explainer, where we break down exactly how to build a recession-proof asset allocation. Thanks so much for learning with us today, and we'll see you in the next one.